Hi there, Dave Westgate from ViperReport.com with the 20 Habits of Wealthy Traders. I've been interviewing traders for about 15 years now to find out what makes the good traders different from the traders who lose money. You've all heard that most traders lose money. Why is that? What makes the difference between those really good traders? How are they finding entries? How are they doing their exits? How are they running their trading business? How are they running their lives around their trading was what I really wanted to find out. I tried to avoid some of the stuff that's kind of obvious that you hear all the time, like, let your winners run, cut your losses. You'll see some hints of those kinds of things, but I really wanted to get to the crux of different things that you may not have heard of that really make the difference between wealthy traders and someone who just struggles constantly, maybe has some winning trades and a lot of losers, because there is a difference there. They are doing something different. So let's get right into it, and we're going to talk about what makes them different. Number one, wealthy traders are patient with winning trades and enormously impatient with losing trades. So this is different than let your winners run. Most traders that are out there, what they do is they get into a winning trade, and what happens? They get extremely anxious. We worry, oh my gosh, I made money on this trade. I better get out now because what's going to happen if it goes into a loser? Right? They start to get very impatient, and they're like got that finger on the sell button because they don't want it to have their winner turn into a loser. On the opposite side, if they've got a trade that is going against them, a lot of new traders and a lot of just traders in general will say, you know what, I'm going to wait just a little bit longer to see if this thing turns around. Does that sound familiar to you? You probably have done that yourself. I know I used to do that a lot more. Wealthy traders turn that just completely on its head. They do the exact opposite. They're patient with the winning trades and give it time to work. And they are ridiculously impatient with losing trades. What does that mean? It means that they are out immediately if it goes against them. Here's an example. Let me show you kind of a little graphical interpretation of what this means. Here's what a trade timeline looks like for a wealthy trader. Losing trade, losing trade, losing trade, big trade winner. Losing trade, losing trade, losing trade, losing trade, big trade winner. So they are incredibly impatient with losers, cutting their losses immediately. Some of them, when they go 2-3 ticks against them, they're out. And if you continually do this, if this is all you do, out of the next 20 things I'm going to talk about, if all you do is immediately cut a loser and let your winners go to their full potential, you will have gone 80% of the way there to doing what wealthy traders do. It's extremely important. So I think there's a lot of people out there that think that wealthy traders just have great trades every single time. Absolutely not true. They've got a lot of losers. In fact, they lose more than they win most of the time. But they are so inherently crazy about cutting those losses that they are able to take kind of the randomness out of it and use that little bit of their edge they have to make their winners go for them and actually do the work and make the money that they are going to make for that week, that month, that year. So, impatient with winners. Excuse me. Impatient with losers, very patient with winners. All right, number two. Wealthy traders realize that making money is more important than being right. There's just this human characteristic we all have that we want to be right about our decisions. You want to make good decisions. You brought that up. You probably raised that way. I want to make great decisions, good decisions that are good for me and my family. The trouble with that is that you get locked into this idea that, hey, this stock is not worth this much money. Or, opposite is, this stock is way undervalued. There's no reason at all for this stock to be this low. I'm buying it. And as the stock continues to go against you, you're like, there's no way I am right about this. I know I'm right about this. We've all heard that old adage, the market can stay wrong longer than you can stay solvent. It's important. They realize that making money is the goal. You cannot express your will onto the market. It doesn't work that way. It will slap you in the face every single time. So that means they need to be able to change sides. If they have a bias in one way, if the market is telling them that they're wrong, that's okay. They'll switch sides and do what the market is telling them to do. You cannot tell the market what to do. It is the exact opposite. So wealthy traders realize that making money is more important than being right. I think that's always a good thing to keep in mind. Number three, wealthy traders look at charts as a picture of where traders are lining up to buy or sell. What does this mean? So in a regular chart, all of us at some point are using technical analysis, even if it's the most simple moving average, the 9-day crossing over the 12, the 3 crossing over the 6, whatever you use. The wealthy traders look at charts not from the lines or the bars on the charts. They see literally, I think they see traders lining up at places where technical analysis zones tell them something is going to happen. So if your idea of a good trade is a certain moving average crossing over another one, they don't see that as an end-all be-all buy point or a sell point. They see it as other traders are there, standing there, waiting in line to buy or sell at that point. They see charts as simply a way to look at where traders are waiting. If you're drawing a line like a trend line down or a trend line across a horizontal trend line and something is crossing above it, they see that as that's not just because it's crossing above the line, it is that's where traders are looking to get in and buy. So they start to see charts in terms of where traders are lining up. Very important distinction. Before they enter any trade, they know exactly where they will exit for either a gain or a loss. I see far too many traders saying, I'm just going to get into this thing. I'll figure out where the exit point is after I'm in, after I get filled. Wealthy traders don't think like that. If they don't know where they're going to exit, either side, whether it's a loss or a gain, they don't get in. You've got to know those points beforehand and have an objective reason why you're choosing those things. So never get into a trade if you don't know where you're getting out for a loss or a profit. Both of those numbers are very important, and wealthy traders know them beforehand. Number 5, they approach trade number 5 with the same mindset they did on the 4 previous losing trades. What I mean by this is, we've all had those times when we get 3 trades in a row, 4 trades in a row that go against us. That's going to happen. Statistically, that will happen. What happens on that 4th or 5th trade that comes along, your setup is there, but now you're gun shy. You're thinking, I'm not reading the market right, something's not right here, I'm not going to take this trade. And what happens? Inevitably, the trade works beautifully and would have wiped out the losses from those previous 4 losing trades, plus made you a bunch of money that day. It's happened to everybody. And it's not because you're reading the market wrong, although there's ways you need to know if you're doing that too. But 99% of the time, it's just statistically, chart patterns don't work 100% of the time. They may not even work 60% of the time. So you've got to know that statistically, there'll be times when 4 or 5 trades in a row don't work. And you've got to, if you're confident in your system and you know you've got an edge in that technical analysis or know that chart pattern, you've got to be able to take that next trade with the same gusto and as enthusiasm as you did those previous 4. Wealthy traders don't get bothered by the idea that they've lost on 4 previous trades. They know statistics, they know that that can happen. And you know every time if you don't take that next trade, if it matches all of your criteria, it's going to be the one winner you didn't take, and it's going to just make you mad even more. So keep that in mind. Number 6, they use naked charts and focus on zones. Let me just show you something here. That's a chart I just threw up there and put a bunch of things in. There's arcs there. We've got Fibonacci. We've got pitchforks. We've got trend lines. Maybe a few moving averages in there. I can barely see the bars anymore. Technical analysis isn't something where the more crap you throw on your chart, the better it works. Let me give you a little secret about technical analysis. There's thousands of different indicators out there. Every single one of them probably works. Every single one will work over time if it's been back tested. You've got to find one that fits your personality and your gut instincts as a trader and use it. So that most of the traders I see that are wealthy, they don't use any. Maybe they've got a couple of moving averages on there. Maybe if they're purely a Fibonacci or a purely Elliott wave, they'll use just that. But rarely will they flip-flop and throw more stuff on. The trade is, if you're waiting for 9 things to line up and say, it's time to trade, you'll get maybe 1 trade every 10 years. That's a long time to sit in front of your computer. And even then, there's a chance it may not work out. So get used to watching price and price only and get a feel for what you're trading. There are some traders out there that can trade something different every single day. My recommendation is find one thing that you trade well. I usually say start with the E-minis, S&Ps, and just trade it with just price. Get used to how that stock reacts to different news items on price, and maybe use one or two things you feel comfortable with. The more stuff you have on the chart, the more confusing it's going to get, and it doesn't help you. It doesn't make you a better trader. Number 7, they realized a long time ago that being uncomfortable trading is okay. And what I mean by that is we all feel like once we start to trade, we're going to get to a point in our confidence level that we're going to sit down every morning at the computer and just be perfectly confident in our strategies, confident in our indicators, in our technical analysis, in our chart reading ability, that trading will somehow become easier. And almost every wealthy trader I talked to told me that that day never came for them, and it probably never will. That you have to be comfortable being uncomfortable. You're never going to get to the point that you're going to be totally in sync with the markets and able to find those trades that are always winners. The reason is because you're never going to have 100% complete information unless you're insider trading, which I hope you're not because you're going to jail. But you have incomplete information about how this is going to work out. This is why I sometimes think that police officers can make good traders, because police officers have to make decisions based on incomplete information. Is that a gun the guy's pulling out of his pocket or a cell phone? I won't know until he either fires it at me or makes a phone call. So you have to be uncomfortable with that. Just know in your heart and your mind that you're never going to get to the point where you're totally confident sitting down. Most of the wealthy traders I talk to say, yeah, every time I put a trade on, I'm a little edgy. And that's okay. I've gotten to the point where I'm okay doing that because I know I'll never have 100% guarantee of what's going to happen next. And that would be the only way you'd be totally confident, and that's not going to happen. So get comfortable being uncomfortable. Number 8, the markets are their workplace. They are a participant, not an onlooker. This is a little more kind of vague, but there's an important point here. I think new traders and even traders that have been in it, doing it for a few years, they almost feel like they don't really belong, like they're an outsider trying to kind of get a nut in somebody else's world. And you got to get past that. You have just as much of right to be there and make your living in the markets as anybody else. You are not any dumber. You are not any smarter than anybody else when it comes to this stuff. There are probably geniuses out there that try to computerize their stuff and couldn't make it work. You have a right to be there. The markets are open to you. Don't feel like you are a fraud by trying to get in there and make money. There will be people out there that will tell you, oh, no. Don't forget trying to trade. Hedge funds they're much better funded. They have much more information than you have. That may be true, but that doesn't mean that you can't get in there with them and make money and learn how to do this. You have a right to be there. Be confident that you are not someone from the outside looking in. You have just as much a right to make money and can do this. You will succeed in this if you work hard at and are diligent about, number 1, cutting your losses immediately and being patient with your winners. Number 9. They stopped trying to pick tops and bottoms. Now, I get a lot of flack on this one because there are a lot of traders out there that say, I make my living on tops and bottoms. And most of the time, I have to say, I don't believe you. Okay? There's a reason why I don't think that that's right. It is extremely difficult to see tops and bottoms. Let's look at this chart here. If you look at this, and I just put this up here from one that I found that was trending well, which is the only type of stock that I would trade anyway. And I put the times or the bars where price trend changes in between red bars. You see the 2 vertical red bars on either side of the bar where things start to change. So how much of that chart do you think is encompassed inside of the 2 bars in each area? Maybe 5%, 4% of the entire chart? So why do you think it is that most traders trying to make 100% of their living in 5% of the chart? Why are we trying to trade and find those tops and bottoms, meaning you have to time it almost perfectly every single time to make a living? How about instead trade outside of those lines when things are trending, when you have a much better opportunity to make money in these markets if you're going long and sometimes even going short? Quit trying to buy tops and bottoms. Almost all of the wealthy traders that I spoke with don't do it anymore. That was a fool's game. They all tried to do it at first because somehow everybody thinks that that's the way to make money, is to find it, right when it comes down to the blue line, I'm going to buy it and it's going to head back up again. It doesn't work that way. Trade with the trend. Especially if you're newer, you're going to have a much easier time making money. Now, inevitably, I'm going to get a few emails today with people saying, no, Tim, you're absolutely wrong. trading pivot points and turning pivot points. I shouldn't say that. Trading turns in that short-term trade is the only way to make money. Well, okay, awesome. I'm glad it's working for you. I never could make it happen, and most of the people that make millions of dollars and hundreds of thousands of dollars, or they're living in the markets, don't do it. So that's all I'm telling you. I'm just giving you a data point. Okay? Quit trying to pick tops and bottoms. Number 10. They stopped thinking about the market as cheap or expensive. If you do one thing today, I want you to never utter in your life again about a stock or a future or an option as being cheap or expensive, because there is no such thing. A stock at $1 may be cheap, but if it's a piece of crap company and you buy it at $1 and it goes to 2 cents, that's the most expensive stock you've ever purchased. Likewise, if Amazon is at $715 and they're about to come out with some new stuff and they're going to crush earnings and it goes to $815, that was a good buy, right? There is no cheap or expensive in a wealthy trader's mind. There is simply one thing. Is somebody going to pay more or less for this in 10 minutes, in 1 hour, in 1 month? That's all they think about. There's no cheap or expensive. It is this going to be worth more or less later? That's it. It doesn't matter how much it is. Google at $1,000 may be a bargain when it goes to $2,000. Okay, I think you get the idea here. Stop thinking about the market as being cheap or expensive. There is no such thing. It is just how much it's worth later to somebody else. So here's a tip for somebody. If you are having a really hard time making money as a trader, which I know a lot of people are, I tell people to do one thing, and it's the complete opposite of what most people are doing right now, which is maybe why they're having trouble making money. I want you to buy higher highs and sell lower lows. If all you do is go out there and buy stock or options on stock that are at 52-week highs and sell stuff that is at 52-week lows, you have greatly increased the chances of you making money. Why? Oh, Tim, wait a minute. Those 52-week highs, those are getting really pricey, getting expensive. Go back and check number 10. There's no such thing. Most people out there, I think, are losing money because they're trying to sell higher highs and buy lower lows because they think it's going to turn. Remember? We're going to go back to number 9. Stop trying to pick tops and bottoms. If you're losing money, if you're having a hard time finding good trades, do this for a month. I promise you, you will start to see results. Buy higher highs and sell lower lows. And it doesn't matter if we're in a bull market or a bear market. Things that are going higher tend to continue going higher, and things that are going lower tend to continue going lower. Okay, you're not going to make money on every single trade this way, but you are going to put yourself in a much better position odds-wise to do well. Okay. Number 11, they are willing to change sides if the market tells them to do so. This is a corollary to it's more important to make money than be right. A lot of guys get up in the morning and they say S&P E-minis are going higher today. Why? Gold's going down or gold's going up, and Yellen's speaking today, blah, blah, blah. The Fed, whatever. They have a bias about what the market's going to do, and they refuse to make any trades that are against that bias. Wealthy traders don't sit in front of their computers in the morning, fire them up, and say, I think the market is going to do X today. You know what they do? They wait and see what the market is going to do, and then they trade that. So it also goes back to not telling the market what to do, because it will always slap you in the face. Change sides if you've got a bias. Everybody has biases in their life. Okay, we have a feeling about what we think is going to happen. If you see the market doing the opposite of it, trade the opposite of it. Don't try to inflict your will on the market. It doesn't work. Number 12, they trade aggressively when trading well and modestly when they are not. I see so many traders who say, I've lost 4 trades in a row. I need to triple my trade size for this next one to do better, to make up for that. No. You can't do that. If you're trading well, you need to trade, or you're trading badly, you need to trade less. Okay? Only trade more when you are in the groove of the market, your trades have gone well that day, then maybe you can scale up your size if it's still in line with your trading plan. If your plan doesn't say to do that, then don't do it. We'll talk about that in a minute. But great traders, wealthy traders, only trade more when they're trading well and lower their trade size when they are not. I had this thing for me, it was part of my trade plan, was if I have 3 losing trades in a row on a single stock, on a stock I was trading actively, I had to go down to a single share until I had a profitable trade. Meaning, I may not be profitable on a single share with commissions, but that I was right about the direction of the trade. I was correct in my assumption and my trade direction. You've got to have something in a trading plan that says, when this happens to me, I'm going to reduce my share size until I'm reading the market better. And if that means you go down to a single share and have to trade a single share until that happens, fine. You know what? I'd rather pay the commissions than buy 1,000 shares of something, be wrong on it, and be $1,000 wrong rather than a $16 commission. People get so hung, oh, well, Tim, I'm going to lose my $50 commission, even if you're trading at a regular full-size broker. If I do that, I can't trade a single share. It's not about paying the commission. It's about getting your mindset into more sync with the market. So put that in your trading plan. 13, they realize the market will be open again tomorrow. I've missed trades. We've all missed trades where we said, this is a good trade, maybe I should get in, and you don't, and it goes exactly how you thought it would, right? There's this idea, and I think it's just human nature, we feel like I've missed it, this fear of missing out, FOMO. I'm never going to have this opportunity to trade Netflix all the way down and then bring it back all the way up. Or I'm never going to have this opportunity on XYZ stock again. I promise you there will be 35,000 opportunities coming up in the future. The market will be open again tomorrow. Don't beat yourself up because you took a losing trade or because you missed something. There are opportunities coming seconds from now. 14. All right, I'm going to hear a little crap about this too, but it's important, and I truly believe it. Wealthy traders never add to a losing trade. Ever. Ever. This goes to cutting your losses quickly. This too. Never, ever add to a losing trade. Now, there is this idea that, okay, trade's going to go against me a few ticks, but hey, I know I'm right on this, so I'm going to double up in size. I'll make even more money when it goes the right way. Never do that. If a trade is not going against you, get out, A. B, at the very least, if you're not getting out right at that tick, never add to it. Now, some people always email and say, hey, Tim, wealthy traders, I have to add to a losing position because I'm trading 40,000 shares at a time and I can't get in to that at the price I want all at once. Okay, I hesitate to even say this because it might give you an excuse to do this and you shouldn't do this. So unless you're trading millions of dollars a day, don't do it. But some people have to because to get the size they need at their level, they have to do it in blocks, and the trade initially may go against them a few ticks before they get more of those blocks in. That is not 99.9% of the traders out there. Never add to a losing trade. Write it on a Post-it note, stick it on your forehead, stick it on your computer. It's important. 15, cash is the goal, but never the measure of success. Why is that? Tim, are we here to make money or are we here not to make money? I'm here to make money. So why wouldn't I make a $1,000 goal my goal for the success if I've had success that day? And the reason is because you're a human being. And when you attach a dollar figure to the success of whether or not I've had a good day trading, you end up making trades you shouldn't be making in order to make $1,000. People who say, I have to make $1,000 every day to pay my mortgage, to pay my bills, to do what I was making when I had a full-time job, you are going to fail because it will force you to make trades you shouldn't be making to get to that goal. Here's a better way to do it. Instead of making cash the goal, your goal as a measure of your success for every trading day should be, did I follow my rules when I got in trades and when I got out of trades? Yes, those things will lead to cash, but as long as it's not cash as the goal you're looking at, if you're following your rules and that becomes the goal, I promise you the cash will follow. But you can't make it the initial goal. You cannot say, I'm going to make $100 a day, $1,000 a day. It doesn't work. Make the goal being, I've had a successful day if I've followed my rules and stuck to my discipline about that. Will you have losing trades and when you've done that? Yes. And yet, guess what? Those days can still be considered a success because over the long term, that will lead to the end all be all, which is money. That's what we're here to do. 16. They read books about mobs and riots. I thought this was interesting. Sure, they read books about options or trading in general, but they also, without an exception, read books about psychology and crowd wisdom. Why? Because that's what the markets is. The markets is simply nothing but a mob and a riot. I put a few of them up here. The Wisdom of Crowds, James Surowiecki, The Art of Strategy, and Markets, Mobs, and Mayhem. When you understand that the markets are nothing but a riot and then it's just human emotion there, buying and selling, you're in a much better position to understand what drives price action. Read those books. 17. All right, now this is probably the most difficult one of all of the 20 that I'm going to do. And actually, there are 30 in here. I'm learning about this still, and this is a work in progress. Okay, I know this may not be a great explanation, but they provide liquidity to the markets while watching price and volume. What do I mean by that? The best way I can describe, and I'm still working on this, so forgive me, and email me if you think you have a better way of describing this. But here's the way I describe it, and somebody described it to me this way, and it started to make sense to me. You go into a grocery store, and you see that 2% milk is the hot item today. Everybody seems to be buying 2% milk. There's just a run on 2% milk. So while everybody else is going to the back of the store, getting into the refrigerator and getting their gallons of 2% milk out and walking up and walking into line with the rest of the people in line to wait to check out, the wealthy trader instead will walk up to the cashier and say, hey, let me get in here and run the cashier for you for a while and buy and sell, and I'll sell milk for you. I'll make a market in 2% milk for you a little bit. And they feel like they are the checkout person rather than the customer. I know that's not the perfect explanation, and I'm working on a better one, but there's something there that wealthy traders are doing. They see themselves almost as a market maker. They treat their trading as a market maker, not as the end retail trader. Okay, just think about that. Give it some thought while you're on the treadmill tonight doing some exercise. I hope you're exercising because that'll help you with your stress level. And I'll get better at this, but think about that. There's something there that wealthy traders are doing. 18, they have a way to gauge fear, greed, and speed of the markets. An example would be tick charts, a 233 tick chart or a 612 tick chart. The problem is on your screen, if the only thing that you're using is a 5-minute, 10-minute, hourly, daily chart, those charts print a bar every 5, 10 hour. They print a new bar on that time frame every time. And there's no way to kind of feel for the frothiness of the market with those because they're printing that way no matter what's happening in the market. No matter how many orders are coming in, they'll print those bars. What I do is I have a tick chart up on the far left-hand corner of my screen. And when I see that thing really start to move, boom, 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 it's just, kind of a signal to me that something is going on. I need to take a look at the markets. And if I only had time-based charts, I wouldn't be seeing that. It would take me longer to see that, hey, something's happening. Something's going on in the market. So use just some way to gauge fear, greed, and speed. That's what the wealthy traders are doing. They have some way to do that. And the tick chart is just an easy way kind of that I talked about that you can do that. 19, they practice reading the right side of the chart, not the left. Everybody can see the head and shoulders after it's already been done, after it's already been built. Everybody can see the triple bottom, the double bottom after the chart. I mean, I could get a 5-year-old to see it once they saw it a couple of times. The trick is wealthy traders are better at reading and seeing those patterns the moment they begin to form. Now, this is a little funky. I'm not talking about having a crystal ball here. But here's what I want you to do to start being better at reading the right side of the chart that hasn't printed yet. When I say right side of the chart, that's what I mean. Where the bars aren't yet, where they haven't printed, the future. We're not talking about mind reading or whatever, or crystal ball stuff. But here's what I want you to do. On something that you're trading a lot and that you're getting to know the behavior of, I want you to look at that last couple of bars and I want you to picture in your mind what the next bar is going to look like. Do that and you'll be surprised at how good you begin to get at seeing where that bar prints. Okay, it's not about voodoo, okay? It's not about reading the future and knowing the future. It's about being able to see those patterns as they form, because that's the only way to make money with these things. It's not to see it after the fact. Anybody can do that, but it's no good to you. You need to be able to see the patterns coming as they come, and the best way to do that is try and read the right side of the chart that hasn't printed yet. 20. Every wealthy trader has an edge they can explain to their mothers. Now, the only person who may not have this is someone who's doing an algorithm, who's a PhD, who has figured out some computerized way to have their edge. For most people, if you can't explain how you make money in the market in between an elevator ride from the first to the third floor, you don't have an edge. If you can't explain it to somebody who doesn't trade, you probably don't have an edge. So it can be something as simple as a moving average crossing over another moving average. It doesn't have to be complicated, but you have to be able to explain it to somebody else and sound like you know what you're talking about when you do that. Because if you can't, it means you've got some area of this that's kind of loosey-goosey, gut feel kind of stuff, and that's not an edge. You've got to be able to articulate what it is, an objective reason why you get into a trade and why you get out. 21. I've got some bonus wealthy trader habits here for you, so we'll go through these pretty quickly. Their position size is calculated exactly on risk tolerance. When I first started interviewing traders, I would ask someone, hey, so what's your standard position size? And they would look at me like, you're the biggest moron I've talked to today. What do you mean, what's my biggest position size? Am I trading something that's $1? Am I trading Google at 700 or 1,000? You got to tell me what I'm trading. I can't tell you. I just trade 1,000 shares of everything. So, light bulb went off in my head. Okay, anybody who tells you that they're trading 1,000 shares of something every time has no idea what they're talking about. Because here's how a wealthy trader would do it. And I've simplified the math a bit, but I want to make it easy for everybody to round up. And I was a poli-sci major, not a math major, so I had to do it easy. On a $1,000 account, if your trading plan is to risk 2%, no more than 2% on any one trade, on a $100 stock, 2% of 1,000 is $20. That means you can buy one share and have an $80 stop loss, or 10 shares and have a $98 stop loss, okay? This is very objective. This is not, I trade 1,000 shares of everything. You have no way of knowing what the average range of that stock is or how pricey it is or what your risk percentage is on any one trade. It has to be determined. And people will use this, the wealthy traders use this formula and they say, okay, if I'm trading Google at 715, blah, 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 I do the math, I get to trade 643 shares of it. And maybe they round up to 600 or down to 600. But the point is, they have an objective way to calculate what their risk is going to be. And you've got to have this too. Work it out for yourself. 2% is kind of standard, but work it out for yourself what you want to do. Okay, now that stop loss has to be wide enough to absorb the daily range, right? On the second example of 10 shares equals $98 stop loss, if the average range on that $100 stock, because it's extremely volatile right now, is $5, you may get stopped out pretty darn quick, right? Likewise, an $80 stop loss, that's probably going to be too far, and with one share, you're not going to make much money anyway. So, you've got to make sure that your stop loss is reasonable within the daily range, average daily range of what that stock moves. So a $100 stock with an average range of $5 means you can trade 4 shares with a $95 stop, and that's your 2%, okay? Calculate this on every single trade. It cannot be, I trade 1,000 shares of something and I get out if it goes $5 against me. If you hear somebody saying that, they are a trader who has no idea what they're talking about. They read one book and decided to make their living trading. Okay? And probably the wrong book. 22. Profit targets are based on average range or something objective. I hear people all the time, I try to get $5 out of every trade. What are you talking about? Do you even know? What if something only normally moves about $1? You're going to wait, and what happens if it goes against you? That makes no difference, or it makes no sense whatsoever, okay? You've got to be able to have your stop loss, you have your stop loss meet the average range. So know kind of generally the behavior of a stock before you start to trade it. You've got to know what the general normal behavior is, and everything will go out of that range, but on a normal average day, if there is such a thing, you kind of know the behavior of that stock. 23. 1 or 2 trades a month make their month. Okay, this was surprising to me. I thought traders who were really wealthy made money almost every day, and that's how they became wealthy. Nope. The way they made money was they had 1 or 2 trades a month that absolutely crushed it, and a bunch of losers, and that's how they made their living. Some of them, it was a little more rare, but some of them had 1 or 2 trades a year that made their year. Can you imagine the patience they would have to and all of the losers that they would have to go through, or tiny winners, to make that? So I think there's this idea that wealthy traders just make money almost every day, if not every day, and that's how they make their living. Absolutely not. They have a lot of losing days too. They're small losers, right, within their range of what is in their trading plan, and then they've got these 1 or 2 trades that absolutely crush it, because they let them win, and they maybe added to it after the fact, after they were already above break even or something like that. That's how they make money. It was surprising to me. Maybe this is surprising to you. 24. Confident decision makers in the face of incomplete information. This goes back to being right. This goes back to taking that fifth trade when you've had 4 previous losers. You're never going to be totally comfortable. You can be confident, but you may still be a little uncomfortable making decisions. You're never going to have total, complete information on what that stock or futures or options or Forex pair is going to do. You got to be confident even when you don't have all of the information, because you never will. You still got to be successful as a trader. A losing trade does not mean they are a loser. This is straight psychological. Just because you are having a bad day does not mean you are a bad person. Sounds silly, right? You want to laugh, but it's the wealthy traders don't take it personally. And I think that's the best way to describe it. They don't take the market slapping them in the face personally. They know it'll be open again tomorrow. They'll do it again tomorrow. 26. They buy higher highs and sell lower lows. This goes back to what I was talking about. If you are losing money in the markets, buy the higher highs and sell the lower lows. It's different than what 99% of the traders are doing out there. And guess what? 99% of the traders out there are losing money. So do what they are not doing, and you will have a better chance of making money in these crazy markets. Their business isn't trading. It's finding the right trades. There are traders that will sit there for 3 days watching the markets and not touch their keyboard. And guess what? They still call themselves traders at the end of those 3 days. Hitting your keyboard and punching buttons is not trading. Finding the right trades and then executing on those trades properly is what makes you wealthy. Being in the markets, and you may miss out on things, the market will be again open tomorrow. They realize that their business isn't hitting buttons, it is making money. So you've got to wait for the right trades to come along. 28, they write down and record every trade, price, thoughts, news, attitude. Keeping a trading journal. You've heard this, but how many of you are actually doing it? Or maybe you started doing it the first few days and like, this isn't helping. Trading journals only work over a long period of time. You've got to write down stuff. I know, one of the wealthy traders I talked to would write more about what he was feeling in terms of his relationship with his new wife than he did about trading. But it was important. It affected his attitude about the markets. It affected his ability to be confident and sit there and find the right trades and be patient. So you never know what that trading journal is going to reveal to you. You have to write it for a while and then go back and read it and see if you can find any patterns in your own behavior that are keeping you from making a lot of good decisions and making money. 29. Their conviction on an active trade remains unless something major changes. This goes back to letting your winners go, and it also goes back to not getting out too early because you're worried that something else is going to happen. If the things that told you to get into the market haven't changed, don't make any changes. I've done it where I've gone in and I've taken half off, or I fiddle with it. Personally, the way I trade is I put a trade on, I put a stop loss in, I put a profit target in, I walk away. Because if I sit there and look at the screen and watch my trade, I will mess it up. I'll get it out, I'll try to add to it, I'll do something that's stupid that's not in my trading plan. So I call it the, set it and forget it trader. That's what I am. It's the only way I found I could make money, and that's okay. But it forces me to stay convicted on an idea that I had unless something changes. And if I'm out. If I'm in with a profit, that's okay too. A winning trade does not result in taking on extra risk on the next trade, just like a losing trade doesn't. Just because you've had a winner doesn't mean you triple your size because you think you're awesome. Okay? If your plan talks about tripling size over time, fine. Be careful with that. But you don't take on extra risk just because you think you're a great trader that day and you're reading the markets well. Okay? Very important. All right. Finally, trade the reaction, not the news. Okay? Most traders try to trade the news immediately if it comes out. The wealthy traders that I spoke with say, I don't trade the news, I trade the reaction after the fact because it's almost always an overreaction. And so I trade the reversion to the mean, right? I trade it back to the normal levels because if I trade the actual news, very few people can trade news unless they're insider trading because you just don't know. You've seen stocks that have beat earnings for the quarter and they still go in the toilet. You don't know what the reaction is going to be. So don't trade the initial reaction, trade the reaction to the reaction, if that makes sense. Okay? All right, so these are just some of the things that I talked about all the time with wealthy traders. I hope you find one or two things that you can implement in your own trading. You may not agree with all of them. I'm just telling you, with traders that made their living in the markets, the things they did to make that money. So I hope you find something useful in it, and make sure you visit viperreport.com every day and subscribe to the newsletter and the blog to find out more. Thanks a lot.